Hi everyone, it's Any, aka the NocTrader. I'm back again with another video, and in this video I'm going to be talking about all of the IPOs for 2019 and what it has in store for us. I know this is really going to mess up the continuity of this video, but I really want to share this with you guys, and I think it's relevant for the topic we're talking about in this video. So on the CNBC YouTube channel, Warren Buffett's been interviewed and he gives his opinion on IPOs, and as you can see from the title, he's skeptical as well, and he's kind of reiterating the same kind of things I've been saying about Lyft in particular. I'm not going to play this video. I'll put the link in the description section because I know YouTube is very they don't mess about when it comes to copyright strikes, and I'm too young of a YouTube channel to be having copyright strikes against my page. So I made this. I just made like this to kind of support it. So basically, what Warren Buffett is saying was that buying new offerings during hot periods, I don't think is anything the average person should think about. So just kind of reiterating, as I said, what I've been saying in this video, which is don't go off the fact that it's a hot period, there's a new offering, and get caught in the whirlwind. It's not something, he said that it's not something that the average person, so to me I interpret as the retail traders should get involved in, because the big institutional investors have already made their money and we're collecting the IPO at a very overvalued price. So I just thought I'd put this here as well, because it's one thing for me to say it, but it's another thing for the guru almighty Warren Buffett to say the same thing. Anyway, back to the video. Now, this is a report by EY. I just thought I'd go through this first. Now, Renaissance Capital said that 2019 is the year of the mega IPO, and I can understand why they say that, because as you can see here, for the last 3 years, 2016, 2017, 2018, the number of IPOs have in the USA has gone up each year, and the total value of these IPOs have gone up in each of these years consecutively. So from 2016 it was about 100 million. No, so yeah. So from 2016 it was about 100 IPOs. Now there's 205 IPOs in 2018. Yeah, so in 2018 there's 205 IPOs in the US market, and this has just been rising year on year from 2016 onwards, and this kind of just indicative of the amount of IPOs that have been going on for the last couple of years, and it's just the number keeps growing. I think that in 2019 this record might be broken again, and there might even be more than 205 IPOs. But for the most part, the IPOs that are getting most attention are, you know, the major ones, you know, the Ubers, Lyfts, Airbnb, Slack, I don't know about Palantir, but Robinhood, Pinterest, Postmate, WeWork. Yeah, these are some of them. They've even missed out ones like Stripe, which I think is one of the more popular ones as well. But these are all just the big tech companies that are really getting most of the notoriety out of the IPOs going on this year. As I said, the global trend, the trends of IPOs is rising for the last 3 consecutive years, and it looks to continue this trend this year with the number of IPOs going up. But my real issue is that with some of these companies, they're big brand names and everyone knows about them, but a lot of them aren't profitable. And call me old school, but I feel like a company, they don't necessarily have to be profitable. They should be working, maybe reducing the amount of losses they're making over the number of years and working their way towards profitability at some point. But with this new, well, it's not new, but Silicon Valley has created this kind of atmosphere where a company will get backed by a VC, financially backed by a VC with millions of dollars, and they won't have to think about profits. All they need to think about is user adoption, or getting their numbers up, getting their user adoption up, and then when they hit a critical, they can run at a loss lead. So companies like Uber and Lyft, Uber's aren't making profits. As you can see here, Lyft's warns it may never make any money. And look, Lyft's history of net losses. So can you imagine this? This is a company that's about to IPO, and they say that they may never make any money. So why would you want to invest in a company like this? I don't understand it. I don't even understand why they're going public. Well, actually, I do. The culture of IPOs is that it's not even a culture. This is the way these top 1%ers make money, and I don't knock them for it. But we're just in a precarious position as retail traders, and you have to be very careful about entering IPOs and getting caught up in the whirlwind of the fact that, oh, I know this company's, and I know them, brand recognition, they're popular, I've used them before, they must be making a lot of money, let me buy some shares in them, I don't want to miss out. There's a reason why they're going public. They're going public because a lot of times there's primary markets and secondary markets. So you have like investors that will get money, will raise money and invest in these companies before that they early on. So they're the ones that are really making a lot of money early on, and then it goes to the stock exchanges. So to people like you and me, who will then probably invest in these stocks, and then they'll spike up, and these investors will have gotten out by then and made their money, made their 10x, 20x, 100x. I don't know how much they'll have made, and we'll be the ones left with the overinflated value of a price of a company that you have to hold. And this is where it might plummet, it might rise again, we don't know, but we're not getting it at the optimal, at a great price, because by the time it's exchanged hands so many times. So these early investors are like investment banks and institutional investors that have lots of capital, so they can enter IPO in the early stages before it's released to the public, and retail traders like us get it later on down the line when it's publicly available, and as I said, the price is inflated. So that's one thing, cause for concern. The second cause for concern is that these companies, they're just not profitable, a lot of them, and it's just this whole Silicon Valley VC culture. They have no intentions of being profitable, a lot of them. As you can see from what I said about Lyft, they have no intentions of ever being profitable. So why would you want to invest in a company like that? They have no intentions of being profitable. As far as I'm concerned, they just want to go public so that the investors can make their money, get out, and then the retailers can be left with shares of a company that they bought just because of brand recognition. As far as I'm concerned, Lyft is a short to me. Well, this is not investment advice, as I said before, but I think Lyft is a short to me, based on just the business model. Sometimes you have to just look at the fundamentals. What do they do? Is there any intrinsic value in what they do? Are these numbers that they're valued at just kind of up in the air, up in the sky numbers? And a lot of times I think they are. It's not all bad, to be honest. I'm talking about a company like Uber and Lyft. Let me just show you this. This is let me shout out this guy actually. Shadow Investing. This is a Instagram page that I follow, and he has some really interesting, or she, I don't know who the person is, he or she, has a lot of really interesting stuff that they have on their page, and it says, is Uber overvalued? Now Uber's been their net profit is 1.8 billion, and they're valued at 120 billion. So they're valued at a higher value than 3M, PayPal, Nvidia, Costco. Yet they're turning a loss. This makes no sense to me. How do you justify this? But for all I know, once they go public, the share price might skyrocket even more. But I just don't think it's sustainable. I don't think this valuation for a company that's turning a net loss can be justified on the market in the long run. So companies like Lyft and Uber, I personally would stay away. Me personally, the type of company I like is a company like Stripe. This is one of the companies that's Stripe is one of the companies that is IPOing this year for at a value of 20 billion. Now Stripe is a great company. They're a digital payment process platform, and this is a company where I can see the business model. I can see there's need for a product like this, and it kind of gives me, similar to, in a way, it's kind of similar to Square, and we all know Square did really well. It's been doing really well. The share price has just been going from strength to strength, and so is Shopify. And this type of company integrates with these type of tools very well, because Square, Shopify, Stripe, they're all in the same sector. different companies doing slightly different things, but they're all in the same sector, and all these companies have been doing really well. So I think Stripe is one of the companies out of all of the most popular IPOs coming in 2019, that I think this is the one that if you're an investor, this is the one I'd personally look at, because they have a business model that makes sense. They provide internet a software for processing payments, and yeah, it just makes sense, doesn't it? And it's a service that's needed. So, but as I said, I'm not really I'm not an investor. I don't I don't really hold stocks or shares for the long term for years on end. I'm more a swing trader, but Stripe is one of these companies one of the companies out of the Ubers, the Lyfts, Airbnb, Slacks, Robinhood. There's a list of them that have really been pushed to the forefront when it comes to IPOs for 2019. But I think Stripe is the one that's got the most prospect, in my opinion. But yeah, that's just my 2 cents. I thought I'd just give a video about IPOs, because there's so much buzz around these going on right now, and I'm not really going to give a full fundamental breakdown. But I hope this video has been useful for you. NocTrader signing out.